Have you ever heard the term regular mutual fund and kind of just nodded along? Well, a lot of us have. But today, we're going to pull back the curtain and demystify these funds. We're going to see exactly what you're really paying for.
Look, if you're just starting out, the whole world of investing can feel, well, super overwhelming. There's all this jargon, so many choices, it's easy to feel lost before you even take the first step. And you know what? That's completely normal.
So let's simplify things. Think about mutual fund investing like you're standing at a fork in the road. You've got two main paths. On one side, you have the guided path, where you've got a professional advisor helping you out. On the other, there's the DIY path, that's do-it-yourself, where you're going it alone. Both paths can lead to the same destination, but believe me, the journey, and especially the cost, is way different. Okay, let's start by walking down that first path, the guided path. This is the world of the regular mutual fund.
So what exactly is a regular mutual fund? At its heart, it's a fund you buy through a professional, an intermediary. This could be your financial advisor, a broker, maybe even the person at your local bank. The point is, you're not going directly to the fund company, you're using a guide to help you get there.
And this right here is the most important thing to get. When you choose a regular plan, you're not just buying an investment. It's more like a package deal. You get the fund for sure, but you're also paying for the professional services that come along with it.
So what are these services? Well, your advisor is there to give you guidance, right? To help you sort through thousands of funds and pick the ones that actually fit your goals. They also offer convenience. I mean, who wants to deal with all that paperwork? They handle it. And ideally, they provide ongoing support, keeping an eye on your investments and letting you know when it's time to make a change. It's a very hands-on approach.
Now, all that sounds pretty great, doesn't it? But that guidance, it comes with a price tag. So let's figure out how this guide of yours actually gets paid for their time.
And here's where it gets a little tricky. With most of these regular plans, you're not writing a separate check to your advisor. You don't get a bill in the mail for financial advice. So, if you're not paying them directly, where's the money coming from? The answer is hidden inside something called the expense ratio. Now, every single mutual fund has one of these. It's an annual fee that covers the fund's operating costs. Paying the fund manager, admin stuff, marketing, all of it. And it's taken right out of the fund's assets automatically every year.
And here it is, the big reveal. In a regular plan, your advisor's commission is baked right into that expense ratio. It's not a separate fee, you see, it's an embedded cost, which means you're paying for their service through a slightly higher annual fee on the fund itself.
So this means the exact same fund can actually exist in two different versions. The regular plan will have a higher expense ratio because it has to cover that advisor's commission. The direct plan, remember the DIY path, has a lower expense ratio because there's no middleman to pay. It is literally the same investment, just with two different price tags.
Now you might be sitting there thinking, come on, how much can one little percentage point really matter in the long run? Well, the answer is a lot. The impact is actually staggering. Let's do a little 20-year showdown to see just how this plays out.
Okay, let's break this down with an example. Imagine you invest $10,000. In the regular plan, with its 1.5% fee, your net return after costs is 8.5%. But in the direct plan, with its tiny 0.5% fee, your net return is 9.5%. Fast forward 20 years, and that 1% difference is absolutely huge. The regular plan grows to around $51,000, but the direct plan, it grows to over $60,000. That is a difference of over $9,000. Just let that sink in for a second. That's the real long-term cost of that 1% fee. It's the price you paid for the guidance and convenience. It's a pretty powerful example of how tiny little fees can compound into big, big money over time. And this chart just makes it crystal clear, doesn't it? You can see both investments grew, which is great, but look at that gap created by the lower fee of the direct plan. It just gets wider and wider over 2 decades. That gap, that's your money. That's the total cost of that embedded commission.
Okay, so we've seen the numbers, we've seen the cost. The big question now becomes, which of these paths is the right one for you? Because it's not just about the money, it's about what you actually need as an investor.
So let's figure it out. A regular plan could be a fantastic fit if you're a beginner and you really want that hand-holding. Or maybe you're just super busy and don't have time to manage a portfolio yourself. If you value convenience and a hands-off approach, it's a solid choice. But if you're pretty knowledgeable about finance, if you're comfortable doing your own research, and if your main goal is to squeeze every last drop of return out of your investments by keeping costs low, then a direct plan is probably for you.
And this really just sums it all up, doesn't it?
If you've got the knowledge and you've got the confidence to be your own captain, to steer your own ship, then yeah, the direct path is almost always going to be the most cost-effective way to build that long-term wealth.
So at the end of the day, it all boils down to one simple question. That higher fee in a regular plan, that's the price you're paying for professional guidance, for convenience, and for peace of mind. And only you can decide if that service is worth the long-term cost to your portfolio.